Hi class, this is Liz Brown with Richland College. Today we're covering the cash flow statement chapter. We have covered 3 of the 4 major financial statements. In order, they would be income statement, statement of stockholders' equity, and balance sheet. Now we're building on that and adding in cash flows. This is something that you do in your personal life all the time. Here is a simple example with a wallet or a purse. If you start the week with $48 in your wallet or purse and end the week with $62 in your wallet or purse, you say, well, I have gained $14 over the week. Why was that? You had cash tips at your job of $75, a dinner out, which you paid an outflow of $46. You had to pay a parking ticket of $25 in cash, and you received an inflow of birthday cash and a birthday card of $10. This is why you had a positive $14 change in your wallet or purse. This is the exact same thing we're doing with the cash flow statement. Over a period of time, in this simple example is a week, the same thing is happening for a cash flow. For this year ended December 31st, we are looking at the same thing. We're going to start actually down here at the bottom. We know that we have net increase in cash of $14,000. Cash at the beginning of the period was $48,000, and cash at the end of the period was $62,000. This is just like our simple wallet example, just with a company. So with this, we know there's 3 things that are going to make up those changes. Changes in our operating activities, changes in our investing activities, and changes in our financing activities. Let's define operating, investing, and financing. Here are 2 ways to look at these terms. Defining it using our financial statements. So operating is made up of revenues and expenses, all of the things on the income statement, changes in other current assets, and changes in current liabilities. Investing is made up of changes in long-term assets, and financing is made up of our debt and our equity, which is changes in long-term liabilities and changes in common stock and changes in retained earnings, which include dividends paid. Or we can look at it in this blue chart, which lists them out more specifically. In operating, we have cash inflows from the sale of goods and services. These are the things that we do to operate. We are in a business and we are operating by selling things and providing services. Also, collections of interest revenue and dividends revenue. All right, these are things coming from the income statement. Cash outflows will be purchase of inventory, payment for operating expenses, payment of interest, which would be interest expense, which is on the income statement, and payment of income taxes, which is income tax expense, also on the income statement. Summarizing them again, we see that this is going to cover revenues, expenses, current assets, and current liabilities. The investing section, cash inflows are going to come from sales of long-term assets, such as sales of investments, sales of long-term assets, collection of notes receivables. Cash outflows comes from the purchasing of those items, so paying cash to purchase an investment, paying cash for a long-term asset, and lending with the notes receivable. Again, defining this, investing is our long-term assets. Financing, our debt and equity. Inflows come from issuing bonds or notes payable and receiving the cash, issuing of stock and receiving that cash. Outflows are for repayments of our bonds or notes payable, acquisition of our treasury stock, and payment of our dividends. I find the most tricky one to be the dividends. Remember, there is no such thing as dividend expense. So dividends are in our debt and equity. All dividends that we pay as a company are in financing. There is such a thing as dividend income or dividend revenue. This is when our company has invested in another company. All right, so I just want to make sure we see that. If we are paid a dividend from another party or an outside company, that goes into operating. But when we are paying our own company's dividends, that will always be in financing. There are 2 different ways to perform the operating section of a cash flow, the direct method or the indirect method. We will focus on the indirect method for this chapter. It is what majority of all companies use for their cash flow statements, and it is just as it sounds. It is indirect. We start with net income and back out non-cash and non-operating items and changes in current assets and liabilities to determine our cash balance. Here we have depreciation. Let's do a very simple example. We are a dog walker. We had revenue of $100 in cash. We had salaries of $30 also in cash. And we had depreciation expense of $10 to give us net income of $60. We know that these two activities are in cash. We started with $100 in cash. We paid out $30. What about depreciation expense? Does depreciation have cash related to it? Let's look at the entry. Depreciation expense, 10, that's an expense, and accumulated depreciation, which is our credit, of 10 as well. Neither of these are cash, and we're focused on cash in the cash flow statement. So looking here, let's do our cash flow, a simple cash flow, using this simple income statement. Our net income was 60. We are going to add back our depreciation because it was a non-cash item. All right, so we're getting $70 here as our cash flow from operating. This should make sense because we had $100 of cash and we paid out $30 of cash, so we know that we have $70 at our company. Let's do another simple example using a gain, which is a non-operating item. Let's say we have our same example with our company. We walked one dog, we received $100 in cash, we paid $30 to our employee, so we know that we have $70 in our wallet for our company. We also had this transaction. Once again, this is a simple example. We had land that we paid $9 for, and we are now selling it for $10. Cash of 10, receiving it, increasing. Land being removed from our long-term assets of 9, and our gain of 1. This gain is appropriately shown in our net income of 71, 100 plus 1 minus 30. Let's take a look at this journal entry. Where is the cash? As you can see, we have cash of 10. Cash resulting from the sale of an investment of this land is going to fall into our investing section. This is not operating. As we can see here, it's a non-operating item. This $10 of cash will be seen on our cash flow statement under investing. This 1 of gain that we're seeing, is this cash? No, it is not cash. So what we're going to do here is take our net income less our non-operating item, which is our gain, to get us a cash flow of 70. This should make sense because we knew that we have $70 in our wallet for our company. Let's take a look at our accounts receivable, which is a change in a current asset. We began the period with 10 in accounts receivable. We added 50. We reduced it by 40 related to cash payments for an ending balance. Here are our entries. Accounts receivable increased by 50. Revenue increased by 50. Cash increased by 40 to reduce our AR by 40 as well. We have an increase of 10 from the beginning balance of 10 to the ending balance of 20. We've increased in 10 over the period. What does this mean for cash? Look at the journal entries here with me. We have cash payments of 40, but we had AR of 50. So what's happening is actually we're receiving less cash than we are revenue. In this case, we are going to do an indirect cash flow, and we will be subtracting the increase in the current asset because we are receiving less cash than we are revenue. Let's take a look at this in this great summary that's shown in your book. I think this is extremely useful, and we will be using this to do an example. To calculate our cash flows from operating activities, we start with our net income. We add back amortization and depreciation expense, add back loss on sale of an asset, subtract a gain on a sale of an asset like we looked at above, subtract an increase in a current asset, which we looked at here with accounts receivable, add a decrease in a current asset, add an increase in a current liability, subtract a decrease in a current liability, and this will give us our net cash flows from operating activities. Let's move into an example.